Okay, the elections are over. The Fed meeting is finished for November. And you might be wondering, Denver neighbors, is now the perfect time to buy a house in our beautiful city? Well, normally, as we transition into the fall and winter months, the housing market would be presenting some unique opportunities for those prospective home buyers who are ready to buy a house. However, this fall, so far we've had 2 Federal Reserve rate cuts and an election was decided, all of which have impacted mortgage rates. So is this the golden opportunity you've been waiting for, or will you feel priced out of the market here in Denver? Well, let's take a look. You know, there was a lot of discussion locally and nationally about how this year's presidential election was causing consumers to delay buying or selling a new home. But let's see how that played out here in our Denver metro area. Because we all know, real estate is driven by the local economy. In September, new listings were up 11.2% year over year, and in October, new listings were up 21.9% year over year. So as far as sellers wanting to sell their homes, the presidential election didn't seem to have too much of an effect, with new listings up for both months. Which is interesting because normally at this time of the year, we start to see a slowdown in listings coming on the market, which makes me believe that the Fed cut gave people confidence to put their homes on the markets in September and October, even though it negatively affected mortgage rates. But I'll get to that. And pendings in September were up 29.1% year over year, and October's pendings were up 23.5% year over year, though as you can see, they're slightly down from September's numbers. And I believe this is because after the Fed's meeting in September, where they dropped the Fed rate 0.5%, mortgage rates rose and continued to rise throughout October, mostly due to economic news and predictions about the election. And as far as listings closed goes, in September, listings closed were down 0.4% year over year. In October, listings closed were up 13.8% year over year, and obviously up from September of this year as well. So even with rates rising after the Fed rate cut of September 18th, we still saw plenty of buyer activity. Next, let's take a look at home values. In September, the median price of a home dropped 1.5% year over year to $571,196 from September 2023's $580,000. But in October, the median sale price jumped 3.1% year over year to $592,950. And that's up from the $575,000 I reported last October. And of course, a dramatic increase from September of this year. So looking at these numbers, I think it's safe to say that the presidential election has not had a negative impact on consumers making decisions to sell or buy homes. Also, let's take a look at both median days in the market, that's the amount of time that a home sits on the market before it goes under contract, as well as weeks of inventory, because we know measuring these will help you know if the market conditions are more favorable to buyers or sellers this winter. In September, median days on the market was up to 26 days year over year, and that was 11 days more than what it was in September of 2023. And then in October, the median days in the market was also 26 days, but that was only 10 days higher than what it was in 2023. So a slight decrease as we're heading into those winter months, which tells me serious buyers and sellers are coming on the market. And although buyers are not making decisions super fast as they were in the past, they are not taking too long before settling into a contract on a home that they want. Then when we take a look at weeks of inventory, that's how many homes we have that need to be sold, we see that September's weeks of inventory went up to 14.4 weeks. And that was a big jump from the 9.4 weeks we had back in September of 2023. And then in October, we see 13.2 weeks of inventory, which is 2.8 weeks up over what it was in October of 2023. However, weeks of inventory in October compared to September of this year are decreasing. So less homes for sale, which is what we would expect this time of year. Another number I like to look at is the list to sold price ratio, especially in the fall and winter months. I personally love it when this number trends downward because it means it's a really good opportunity for negotiation. The median closed to original list price ratio was 97.4% for detached homes and 97.3% for attached homes. Now remember back in 2020, this number went way over 100%. That's where a lot of those bidding wars came in, where sellers were getting over asking price and over the original list price. And we can translate that percentage into a price discount from the original list price of 2.7% for attached homes and 2.6% for detached homes. So based upon our current median sale price, that could be as much as $15,416 in your pocket as a buyer. And as a seller, if you were to take that number, you could seriously negotiate some rate buy-downs for a buyer and really be a hero, as well as attracting more buyers to your property while still keeping your list price. Now, let's talk about the impact of the Fed decisions this fall and winter on mortgage rates. Remember, the last Fed meeting on September 18th was the most highly anticipated in a long time due to the rare uncertainty about the size of the rate cut. For those of you who weren't paying attention or weren't following that, ended up being 0.5%. That was huge. Meeting this past Thursday was the opposite of that, with little doubt about the outcome because, as expected, the Fed reduced the federal funds rate by 25 basis points to a target range of somewhere between 4.5% to 4.75%. According to the statement, the routes to achieving employment and inflation goals were roughly in balance. Inflation easing back down closer to the Fed's 2.0 target and the labor market softening, officials intend to gradually reduce the federal funds rate to more neutral levels. You know, most investors anticipate that the Fed will cut the rates by another 25 basis points at the next meeting on December 18th. However, hold that thought. Now remember, first, it's important to distinguish between short-term and long-term interest rates and to understand the impact of the Fed rate cuts on mortgage rates. The Fed controls the Fed funds rate, which is essentially a short-term lending rate for banks. On the other hand, mortgage rates are closely related to long-term interest rates, which are determined by a bunch of factors, such as the outlook for economic growth and inflation. As a result, the changes to the federal funds rate, such as the one that just took place last Thursday, don't really have much impact on the mortgage rates, as they usually already have been priced in. On Wednesday's CPI report, that's the Consumer Price Index report, which measures inflation as experienced by you and me, the consumer, in our day-to-day living expenses. Have you been to the grocery store lately? That report showed that inflation ticked up slightly to 2.6% year over year, higher than the September's 2.4%. After you remove food and fuel prices so you could see the underlying inflation or core inflation trend, that's holding steady at 3.3%. So the CPI report underscores why the Fed has been slow to declare victory over inflation. While that 2.6% is a lot better than the 9.1% peak inflation we saw back in 2022, certainly isn't back to normal, and it's certainly nowhere near the 2.0% that the Fed has targeted. Remember, I told you to hold that thought on Fed rate cuts? Also have to add in election results, and that's what they're now calling the red sweep. A red sweep or a unified government is usually more favorable to U.S. stocks, and we've seen that since the 1950s, in the election years featuring a Republican president with a unified Congress. You know, U.S. stocks record gains of over 5% 1 month after the election. However, this can also increase rate pressures as markets see full control as a path to larger economic or policy shifts. Therefore, the Fed's latest 0.25% rate cut might be the last one for a while, as inflation has ticked back up to 2.6%, raising questions about the usefulness of future rate cuts. Plus, with Trump coming back to office, some economists warn that his policies could accelerate inflation and reverse the Fed's progress. His plan for steep tariffs on imported goods, expanded energy production, and immigration reforms are set to reshape the economic landscape, impacting everything from consumer prices to the housing market. But the big question is whether or not they will increase the prices or lower them. What do you think? Leave your comment down below. And this might be why we're seeing rates tend to hold currently higher in the mid-sixes as I film this. Now, you know, mortgage rates are driven by a mix of economic signals, government policies, and market reactions. So while the election and the Fed moves play a role, broader economic factors will ultimately shape where rates go. So what can you do as a home buyer? Well, given where we are currently, think about the following 4 strategies. 1, monitor the mortgage rates. Connect with your trusted lender. And if you don't have one locally here, reach out to me. I'm happy to share my list of trusted lenders with you so that you can stay on top of interest rate trends and forecasts. 2, review your financial readiness. This might be your opportunity to look at a stable income, good credit scores, and some savings to be prepared for home ownership, as well as various ways to make home ownership more affordable, like a reverse mortgage or house hacking, both of which can help lower your housing costs. And 3, consult with a real estate professional. If you're thinking about moving to our area, you're local here, please reach out to me. I'm more than happy to provide you with the insights tailored to your circumstances that will help you if you decide that making a move is what you want to do. And then 4, be prepared to negotiate. With higher mortgage interest rates and with more inventory available, buyers will have more choices, which means sellers and buyers may take this opportunity to negotiate in ways that help both parties get what they want. Flexibility and patience are key this fall and winter. In conclusion, with the election settled and the latest market reports in, the Denver metro area buyers and sellers are simply moving ahead with their plans. And you should too. This means that this fall and winter months might be the golden opportunity that you've been waiting for to buy a house. Hi, my name is Peggy Dursoff, a realtor with Live Denver Suburbs, powered by HomeSmart. And if you enjoyed this video, check out this video over here where I discuss whether living with family or living solo is the way to go in this market. Thank you for watching, and I'll see you in the next video.